Hello, and welcome back to Reflections on Investing with the Cornell Capital Group. And today we're going to talk about one of the most basic concepts of investing, risk. There's overwhelming evidence that when it comes to a large part of their net worth, like their retirement savings, that investors are risk averse. And what that means is they will demand a premium for holding risky assets. If the 10-year Treasury is yielding 4.5, which is about what it is today, they will demand an expected return greater than that to induce them to bear risk. Well, it's easy to talk about risk, but what exactly do we mean? Academics tend to use mathematical definitions of risk, like the standard deviation of returns. But that may not be relevant for real-world investors. Risk to them is what they perceive to be risk. And let me give you an example of how that perception may change over time and thereby influence the level of the market. So let me start with the period January 1st, 2000 up through December 31st, 2013. And that's shown on this graph for the S&P 500. And you can see that if you bought your portfolio on January 1st of 2000, within a couple years, you'd lost half your money. Ouch. That's real risk. Now, if you were willing to hang on, it would take about 5 years, but you'd finally get back to where you were. Unfortunately, you'd only stay there for a very short period of time, when once again you'd now lose more than half your money. Again, ouch, ouch. And you wouldn't get back to where you started until 2013. People who lived through that would have a very gut-wrenching perception of what risk was, and it would affect the premium they would demand for holding risky assets. Here's a more recent graph. It's from January 1st of 2009 up through December 31st of 2024. And you can see that though there were a couple of downturns, they were short and immediately followed by greater returns. And over that 15-year period, it was up and away. If for every dollar you had invested at the beginning, you would have about $9 today. In fact, let's look at the actual year-by-year returns. And you can see that every year from 2009 to 2024 was positive, and in many cases, very positive. The only exceptions were 2018 and 2022, and they were both preceded and followed by very large positive returns. And for every dollar you'd invested in 2009, by 2024, you'd have $8.7. That doesn't feel like much risk. You wouldn't demand much of a premium if you thought the market was always going to be going up, and in those rare circumstances where it went down, it was followed by yet a bigger positive return. Now, here's why all that's important for understanding the level of the market. And let me bring up a spreadsheet where we calculate this. Now, I'm not going to go through the details of this spreadsheet. We explained it in an earlier Reflections on Investing on the Cornell Damodaran approach to estimating the equity risk premium. What I'm going to show you is how important the perception of risk is for pricing stocks in the market. So if you look at the spreadsheet on the screen, the key thing we're going to change today is the equity risk premium. It's now shown as 3.56. That's an estimate of how much over the 10-year Treasury rate investors have to expect in order to hold the market portfolio. And if we use that's called the equity risk premium, and if we use that risk premium of about 3.5%, we get a level for the market, you look down here at the bottom, of 6,027, which is almost exactly where the market is today. It's actually, if I change this here, it's actually at 6,025. Now, the reason for bringing up this spreadsheet is I want to illustrate to you how sensitive the valuation of the market is to the risk premium that investors require. A more normal premium over the last 25 years isn't 3.56%, it's 5%. So let me enter 5%. Let's see what happens. If I enter 5%, the intrinsic valuation of the market drops from about 625 down to 42.97. Oh gosh, that's a risk I don't want to have to deal with. On the other hand, if the risk premium were to continue to go down, let's say to 3%, that's consistent with a market at 71.50. So I think you can see that the perception of risk in the current market conditions is a critically important determinant of the fundamental level of the market. And if you think that risk premiums are going to continue to decline because investors are confident, it's a reason to buy the market. But if you thought that risk premiums were going to revert to previous historical levels, then it's a very dangerous time to be holding stocks. So what we like to say here at the Cornell Capital Group is the biggest risk to the market is the perception of risk itself. This has been Reflections on Investing with the Cornell Capital Group. Thanks for joining us.